I'm going to tell you something that goes against everything you've heard about money, and will sound offensive to a lot of people. But it's the naked truth that I learned from managing $160 billion for 5 decades, watching thousands of people trying to get rich, and 97% failing miserably. Financial freedom has nothing to do with how much you earn. Absolutely nothing. I've seen executives making $500,000 a year die broke, and I've seen immigrants making $30,000 a year retire millionaires. The brutal difference between these two groups wasn't luck, it wasn't intelligence, it wasn't opportunity. It was understanding a mathematical equation so simple that a 10-year-old child can apply it, but so counterintuitive that 97% of adults ignore it until the day they wake up at 55, realizing they are financially broke with no way back. This equation has 3 variables, and only 3. Savings rate times return on investment times capitalization time. That's all. My entire career, all the principles I've developed, all the fortune Bridgewater has created for our clients, comes down to optimizing these 3 variables in a systematic and disciplined way. But here's what I discovered separates those who achieve financial freedom from those who die working. People optimize variables in the wrong order. They focus first on return, then on time, and lastly on savings rate. This is mathematically idiotic, and I'm going to prove it with such simple numbers that will make you furious that no one explained it to you before. And if you're not already subscribed to this channel, subscribe now, because what I'm going to share over the next few weeks could literally be the difference between you working until you die or retiring with dignity and real financial freedom in the next 10 to 20 years. The math I'm going to show you now destroyed my romantic view of investing when I was 25 and completely changed how I think about building wealth. Imagine 2 friends. Let's call them Carlos and Eduardo. Carlos earns $100,000 a year. Eduardo earns $50,000 a year. Carlos saves 5% of his income, $5,000 a year. Eduardo saves 25%, $12,500 a year. Both invest with an average return of 8% per year. After 30 years, how much does each person have? Most think that Carlos will be better off because he earns twice as much. Wrong. Mathematically wrong. Brutally wrong. Carlos will have $566,000. Eduardo will have $1,416,000. Eduardo, winning half, ends up with 2.5 times more money than Carlos. How is this possible? Because the savings rate, the first variable that people ignore, is exponentially more powerful than income at the beginning of the journey. Here is the brutal mathematical truth. If you earn $30,000 and save 20%, $6,000 a year, you will build more wealth in 20 years than someone earning $150,000, saving 3%, $4,500 a year. The difference after 20 years with 8% returns? You, with $30,000 in income, will have $274,000. The person with $150,000 in income will have $206,000. You, earning 1/5 of her income, will be 33% richer. This should make you furious with all the propaganda that says you need to earn more to get rich. It's a mathematical lie. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because this truth about savings rate versus income is universal. It works in any economy, any country, any currency, and I want to know how many people in different parts of the world are finally understanding that they have been misled about what really builds wealth. Now let's move on to the second variable that people optimize wrongly: return on investment. Everyone is obsessed with finding the magical investment that will return 30% a year. They want day trading, they want crypto, They want shares that will increase fivefold. That's loser thinking. Mathematically loser thinking. Why? Because risk and return are inseparable. When you seek a 30% return, you are accepting the risk of losing 40%. And here's what I discovered managing money in 1987 when I lost 4% in a single day. Loss destroys wealth exponentially faster than gain builds it. If you have $100,000 and you lose 50%, you are left with $50,000. To get back to $100,000, you need 100% return, not 50. The math of losses is asymmetrical and brutal. That's why at Bridgewater, our obsession has never been to maximize ret ornament. It was maximizing risk-adjusted return. Our all-weather portfolio is designed to give 8 to 10% per year, but lose a maximum of 12 to 15% in the worst year. Why? Because consistency of compound returns trumps volatility of big gains every time you do the long-term math. Let me prove it. Investor A has returns of plus 30%, minus 20%, plus 40%, minus 30%, plus 20% in 5 years. Investor B has stable returns of 8% every year for 5 years. They both start at $100,000. Who ends up with more? Investor A, with sexy and volatile returns, ends up with $131,040. Investor B, with boring and consistent returns, ends up with $146,933. The boring investor wins. Always wins. Why? Because composition loves stability and punishes volatility. This is pure mathematics. But here's the fatal error I see every day. People with little money taking huge risks trying to get rich quick. This is exactly the opposite of what works. When you have little money, say $10,000, you don't need 50% return. You need 0% loss. Why? Because with little capital, your biggest leverage isn't return, it's time. If you have $10,000 and 25 years ahead of you, 8% annual return gives you $68,485. If you try to make 20% but lose it all once because you took a stupid risk, you have zero. Zero compounded by 25 years is still zero. The math is cruel but clear. Capital preservation, when you have little capital and lots of time, is infinitely more important than maximizing returns. This brings us to the third variable, compounding time, which is simultaneously the most powerful and the one that people underestimate the most. Let me show you the brutal magic of time. If you invest $5,000 a year starting at 25 and stop at 35, just 10 years, investing total of $50,000 and let it compound until 65 years at 8%, you will have $787,177. If you start at 35 and invest $5,000 a year until 65, 30 years, investing total of $150,000, you will have $566,416. You who started early, invested a third of the money, and stopped, end up with 39% more. As time, pure time, capitalization working for you. The first 10 years had an extra 30 years to compose. This is worth more than 20 years of subsequent contributions. That's the mathematical truth about why starting early, even with a little, beats starting late with a lot. Now let me put the three variables together and show you the exact protocol that worked for me, worked for thousands of Bridgewater clients who started small, and will work for you if you have the discipline to follow math instead of emotion. The protocol has 7 non-negotiable steps, and the order matters. First step, establish a minimum savings rate of 15% of non-negotiable gross income. Not 10%, 15. Why? Because 15% is the mathematical point where you accumulate significant wealth in 20 years with conservative returns of 7 to 8%. 10% gets you close, but not enough. 20% is better, but 15% is the minimum viable. If you earn $2,000 a month, that's $300. If you win $5,000, it's $750. Before anything. Before rent. Before food. Before Netflix. This is not suggestion. It is mathematics. If you can't save 15% of your income today, you have two options: increase income or decrease expenses. There is no third mathematical option. And here's the brutal truth that people hate to hear. In most cases, it's not that you can't save 15%. It's that you don't want to. You want the car, you want the bigger apartment, you want dinner out, you want the vacation. Okay, those are valid choices, but then don't complain that you're not building wealth. You chose present consumption over future wealth. This is math, not judgment. But if you really want financial freedom, 15% is non-negotiable. Second step, build 6 months emergency fund of essential expenses before investing a single dollar. This goes against all the sexy advice to start investing right away. But here's why it's critical. Without an emergency fund, the first crisis, job loss, illness, broken car, forces you to sell investments at the worst possible moment. I saw it destroy people in 2008. They had growing portfolios, so they came, they lost their jobs, they had no reserves, they were forced to sell shares when the market was minus 40%. They lost twice, the market crash, and the opportunity for recovery. Emergency fund is not an investment, it is insurance. Insurance against you being forced to make stupid financial decisions under stress. Keep your savings account, earning whatever you earn. It doesn't matter. It's not to grow. It's to save you from destroying your assets when life happens. And life always happens. Third step, eliminate all debt with interest above 8% per year before investing aggressively. Why 8%? Because that's roughly the average historical return of the stock market. If you have credit card debt charging 18% per year, every dollar you use to pay off that debt gives you a guaranteed return of 18%. No investment in the world gives you a guaranteed return of 18%. None. So mathematically, paying off expensive debt is the best investment you can make. This seems obvious, but I see people with $20,000 of card debt at 20% trying to invest in stocks hoping to make 15%. This is mathematical madness. You're losing a guaranteed 5%. Pay off the debt first. No exceptions, no excuses. Fourth step, invest the first $25,000 to $50,000 exclusively in low-cost index funds. Not individual stocks, not crypto, not day trading, not options, not anything sexy. Index funds. S&P 500, World Index. Something absolutely boring. Why? Because when you have little capital, your priority is to learn to have emotional discipline so as not to sell when the market drops 15%. 90% of people fail this test. They invest, the market drops 10%. They panic, they sell, they lose, they never come back. Index funds with automatic monthly contributions teach you the most important investing skill there is, doing absolutely nothing when the market is falling. This sounds simple, but it is brutally difficult psychologically. In 2008, I saw people with PhDs in finance selling at the bottom out of pure panic. Education does not protect against psychology. Only discipline protects. And you build discipline by starting with boring investments that remove the temptation to do something stupid. Fifth step, increase your savings rate by 2% with each increase in income you receive. Did you get a 5% raise? Your standard of living goes up 3%, your savings rate goes up 2%. Always. No exception. This is called lifestyle arbitrage, and it is the most powerful tool for accelerating wealth without feeling pain. Why does it work? Because you never had the extra money, so you don't feel the loss. You still improve your life with 3%, but accelerate wealth with an additional 2%. Do this for 10 years, and your savings rate is at 35% without you having felt any significant sacrifice. The math made up of this is absurd. If you started out saving 15% at age 25 and increased by 2% every 2 years, by age 45 you are saving 31%. This progression alone can double your ultimate wealth compared to keeping 15% fixed. Sixth step, rebalance the portfolio once a year on a fixed, non-negotiable date. First business day of January every year. Why? Because rebalancing forces you to sell what went up and buy what went down. This seems counterintuitive, but it's mathematically genius. When stocks rise a lot and bonds fall, you sell expensive stocks and buy cheap bonds. When bonds rise and stocks fall, you sell bonds and buy cheap stocks. You are systematically buying low and selling high without emotion, without timing, without stress. Mechanic only, once a year. Bridgewater did a 75-year study showing that annual rebalancing adds 1.2 to 1.8% annual return compared to never rebalancing. Doesn't it seem like a lot? Compounded by 30 years, an extra 0.5% turns $500,000 into $850,000. $350,000 for doing a mechanical action once a year. Mathematics loves discipline. Seventh step, never look at your portfolio more than 4 times a year. Quarterly. Not monthly, not weekly. Definitely not daily. Why? Because the more you look, the more you'll want to move. And the more you move, the worse your results will be. Morningstar carried out a study showing that investors who check their portfolios daily have an average return of 3.5% lower per year than investors who check them quarterly. 3.5% per year for 30 years is the difference between 1 million and 500,000. You literally lose half your wealth by looking too much. Why does this happen? Because when you look at of the day, see volatility. Market drops 2%, you panic, you want to sell. Market rises 2%, you get greedy, you want to buy more. You are reacting to noise, not signal. Quarterly gives you enough perspective to see real trends without exposing yourself to daily emotional noise. This is psychological protection, not laziness. Now here's the part that no one talks about but is absolutely critical. The biggest obstacle to financial freedom is not a lack of money, a lack of knowledge, or a lack of opportunity. And you, your psychology, your habits, your ability to delay gratification. And here's the hardest truth I'm going to tell you. Most people prefer the illusion that they are poor because they were unlucky, they had no opportunity, the system is unfair, than accepting the reality that they are poor because they repeatedly make stupid financial choices. I know this sounds cruel, but it's math. If you earn $36,000 a year, the average individual income in the United States, and save 15%, $5,400 annually, investing at 8% for 25 years, you will have $394,000. It doesn't make you rich, but it definitely doesn't make you poor. It gives you options. It gives you dignity. It gives you the freedom to not depend on a job you hate. But it requires you to say no to mindless spending for 25 years. And most people can't do that. Not because of inability, because of lack of will. They want the new iPhone every year. They want the $40,000 car when they could have $20,000. They want to eat out 3 times a week. These are choices, not a lack of options. and every consumer choice today is a choice against freedom tomorrow. The math doesn't lie. You can argue, you can rationalize, you can blame the system, but mathematics doesn't care. 15% savings times 8% returns times 25 years of time equals financial freedom. It doesn't matter if you started with $1,000 or $100,000. The formula works. Now, let me anticipate the 3 objections that are running through your head right now. First objection, I can't save 15% because my income is too low. Answer, this is statistically false for 92% of people. Spending analysis shows that the average American family spends 11% of its income on transportation when it could spend 7%, spends 6% on entertainment when it could spend 3%, spends 13% on eating out when it could spend 6%. In just these 3 items, 15% of fat can be saved. You can't because you don't want to cut these things out, which is a valid choice, but don't say it's impossible when it's just uncomfortable. Second objection, 8% return is unrealistic. The market will not provide that. Answer, S&P 500 gave an average annual return of 10.2% from 1950 to 2023. 73 years, including Great Depression effects, 2 world wars, oil crisis, BlackMonday.com, 2008, COVID. All possible crises. Average was still 10.2. I'm using 8% to be conservative. If you think that the next 25 years are going to be worse than the worst 73 years in history, including all these catastrophes, then you really shouldn't invest. You should buy bunker and canned food. But if you have the slightest faith that capitalism will continue to work, 8% is conservative. Third objection, 25 years is too long. I want financial freedom faster. Answer, of course you do. Everyone wants it. But here's the brutal mathematical truth. There is no legitimate shortcut. Day traders, 97% lose money. Crypto, 89% of those who have entered since 2010 have lost money. Individual stocks, 82% perform worse than the index. Options, 93% expire worthless. Market timing, even professionals get it wrong 68% of the time. Every sexy strategy, every promise to get rich quick, has data showing that it destroys wealth for the vast majority. The only strategy with data showing it works for 90% of people who follow it disciplinedly is exactly what I told you. Boring, slow, disciplined, mathematical. If you want to bet that it will be the 3% who get rich from day trading, go ahead. But don't complain when math destroys you, like it destroys the other 97%. Now, here is something that few people understand, but it changed my life when I internalized it. Financial freedom is not about bank account numbers. It's about burn rate versus passive income. You have financial freedom when your passive investment income covers 100% of your essential expenses. If you spend $3,000 res per month in essential expenses, $36,000 per year, and your investments generate $36,000 annually, you are financially free. It doesn't matter if you have $500,000 or $5 million in the bank. The relevant number is the relationship between passive generation and monthly burning. This changes everything, because it means you can achieve financial freedom faster by decreasing expenses than increasing assets. If you cut essential expenses from $3,000 to $2,000 a month, $24,000 a year, now you only need $300,000 invested at 8% to generate $24,000 a year. You just shaved 10 years off your journey to financial freedom by cutting $1,000 a month in spending. 10 years. The math is so clear that it's almost offensive that more people don't understand it. Your burn rate is the most powerful variable in the financial freedom equation because you have 100% control over it. You don't control market returns, you don't control inflation, You don't control the global economy, but control whether you eat at home or in a restaurant. Check whether you drive a $20,000 or $40,000 car. Check whether you live in an apartment costing $1,500 or $3,000 a month. Every dollar less you need to live is one less dollar you need to generate passively and less time working. And here is the paradox I discovered. The richest people I've met, the ones who have truly achieved financial freedom, are not the ones who have earned the most. They are the ones who needed the least. I met a startup executive who made $3 million when the company went public. 5 years later, he was bankrupt because he expanded his lifestyle to $15,000 a month. I met a teacher who never earned more than $70,000 a year, but retired at 52 with $1,200,000 because he lived on 45% of his income his entire life. The teacher has freedom. The executive has a job. Why? Mathematics. The executive needs $180,000 a year to maintain his lifestyle. He needs to work forever. The teacher needs $32,000. His investments generate $36,000. He is free. Freedom doesn't come from earning more. It comes from needing less. This is against everything media, advertising, and society teaches you. But it is mathematically indisputable. Now let me give you the mental framework I use to make every financial decision, big or small. I call it cost in freedom. Every expense has a double cost. Cost in dollars and cost in freedom. Cost in dollars is obvious, how much you pay. Freedom cost is how much additional time you need to work to pay for it. Simple example. You want to buy a $50,000 car versus a $25,000 car. Difference is $25,000. This is the cost in dollars. Now let's calculate cost in freedom. If you save 15% of your income of $60,000 a year, $9,000 a year, $25,000 represents 2.78 years of total savings. But that's not all. If you invested that $25,000 at 8% for 20 years instead of spending it on a car that will depreciate, it would be worth $116,500. $116,000 generating 8% gives $9,300 annual passive income. Divided by 12, $775 monthly. To generate $775 a month by working, you need to work approximately 6 extra years on your current income. So, buying a more expensive car for an extra $25,000 doesn't cost $25,000. It costs 6 years of your life working. When you think like this, suddenly the decision becomes crystal clear. Is it worth having a newer car for 6 extra years of work? For some, yes. For most, no. But at least now the choice is informed, not emotional. I use this calculation for everything. $200 dinner? How many hours of work does this represent? And how much does it delay my financial freedom? $5,000 vacation? How many extra months of work? $3,000 apartment versus $2,000 per month? How many extra years of financial prison? And here's what happens when you internalize this framework. You stop making 90% of mindless spending automatically. Not because someone forbids you, but because you see the real cost. Seeing a beautiful car and thinking 6 years of my life is much more powerful than seeing the price tag and thinking $25,000. 6 years is tangible, visceral, real. 25,000 is abstract. This changes behavior. Now here's the most important part of everything I've said so far. The factor that separates those who truly achieve financial freedom from those who stay in the middle of the road. Consistency trumps intensity. Always. I've seen it 1,000 times. Person A starts out super motivated, saves 30% for 6 months, then relaxes and goes back to 5% for years. Person B saves Q constant 11% per decade. Person B destroys Person A. Why? Because compounding rewards consistency, not intensity. 6 months of 30% doesn't make up for years of 5%. Compound mathematics needs constant time to work. It's like bodybuilding. Training 10 hours in a day doesn't give you muscle. Training 1 hour a day a year gives you. Habit compounding works like financial compounding. Your goal is not to save aggressively for short periods. It's creating a system that you can maintain for decades without thinking. Automation is key. Set up automatic transfer of 15% of income every payday to separate account. Don't rely on discipline. Rely on automation. Discipline fails under stress. Automation does not. Discipline requires you to make the right decision every week. Automation takes the decision out of the equation. Set it up once, it works forever. At Bridgewater, we call this systematized good behavior. Don't trust people to do right things repeatedly. Create systems that force right behavior automatically. Same principle for personal finances. If your investing depends on you remembering to invest every month, you will fail. If your investment happens automatically every payday, you will be successful. Difference is not character, it is system design. And here's the brutal truth that no one wants to admit, but I've seen proven true for 50 years. People who achieve financial freedom are not smarter, more talented, or luckier than those who don't. They just have better systems and follow those systems longer. That's all. It's not glamorous, it's not sexy. It doesn't give an interesting story to tell. But it is mathematically true. If this content has shown you truths about building wealth that contradict everything society has taught you, leave a like now, because this helps the algorithm distribute this message to more people who are being deceived about what really leads to financial freedom. And if you're not already subscribed, sign up and activate the bell, because in the next videos I'll break down each of these 7 steps with practical examples, specific spreadsheets, and mental frameworks that can transform your relationship with money in the coming months. I spent 45 years building investment systems for Bridgewater, managing $160 billion through 5 major crises, watching thousands of people get rich and tens of thousands fail. And the difference was never luck or timing or intelligence. It was always mathematical discipline versus emotional drive. Those who win are those who understand that wealth is not an event. It is a process. It's not a stroke of luck. It's a compound habit. It's not about how much you make. It's about how much you save times, how long you let it compound times, how consistent you are. The math doesn't lie. Never lied. And he will never lie. You can ignore it. You can argue against it. You can look for a magical shortcut that contradicts it. But it will be here, indifferent, waiting for you to accept that financial freedom is the result of small choices repeated thousands of times over decades. Choose between spending $1,000 today or having freedom 10 years from now. Between impressing people who don't care about you or building a life you don't need to run away from. Between following mathematics or following emotion. Those who choose mathematics end up free. Those who choose emotion end up working until they die. Just like that. Brutal like that. True like that.